Good afternoon and welcome to today's Investor Spotlight event featuring 3 new companies ready to present an overview of their investment case and tell you why they believe their company is an attractive opportunity for investors. So let's get started. First up, we have Blackbird. Ian, Sumit, thank you so much for giving us your time this afternoon. Let's jump straight in. What's the latest from Blackbird and why should investors take notice?
I'm Ian McDonough and I'm the CEO of Blackbird PLC, the company behind Elevate.io, which is the collaborative video editor that works fully in your browser. Today I'm joined by Sumit Rai, who is our Chief Product Officer, and I'm going to ask Sumit a few questions about the product positioning and about who it's for and where we are in terms of the journey, and really why now is the time to invest in Blackbird and Elevate. Sumit, can you tell me a little bit more about yourself and then a little bit about Elevate and where it fits into the editing landscape?
Well, when I joined Blackbird, we obviously discussed the idea of building a product like that. We wasn't called Elevate at the time, but that was the idea. And the main reason was because throughout my industry, throughout my career, which started off with tape editing, we saw the jump to the Avid-based nonlinear. We saw the jump then to the Final Cuts, the DaVincis and the Adobe Premieres of today. And we sort of thought, okay, well, with each jump, it's actually made the creation of video much easier. However, as the market has just exploded, like we were at that conference last week, everybody had a video story. If you'd have been there 2 years ago, most people would say we're looking or we're doing something, but now everyone has a video story. So what is that next tool that needs to be built, or that we are building, that enables the mass market to actually create content?
And why is it that someone would want to switch from what they're doing now? As you say, everyone is working with video already or has some kind of video story. Why would they want to switch to Elevate?
So the existing tools are brilliant for the highest end of production. If you were producing a film today, you've got a lot of great options for those, or television programs, and they're very refined. So we see that bit of the market as absolutely sewn up. However, for the majority of the market, which means the YouTubers, it means education, it means corporate communications departments, they don't have the same requirement. They don't have that requirement at the top end of color correction and file format support. But what they do need is things like collaboration, ease of content management, low-powered computers to actually run the product on. And these are the things that are actually quite hard for them to do because, you know, especially in education, they don't tend to have access to hugely powerful computers. In corporate communications, it's always a team effort. And editing is traditionally a very solo effort. It usually is whatever machine the project starts on, whoever started the project tends to be the one who finishes it. So we know that the future for us, and the reason that we're positioning Elevate as a collaborative video editor, is so that we can unlock the things that make it difficult for the new, let's just say the people who are last to join the video party, or the newer people to join the video party.
I really got the impression that everyone knew how important video was to their business, whether it's promotional, whether it's communications, but it was really the bane of their existence. They didn't want to be creating so much video. They wanted it to be over very quickly. How does Elevate help with the speed of content creation?
Well, that's the truth. Everyone knows that video is effective. It's just that video traditionally is more effort. And that's completely reasonable. If you look at the effort required 20 years ago, it's immense. Even the effort required 10 years ago is a lot more than it is to even produce, for example, certainly web-based assets like digital assets and even print. And so the one thing that has always got in the way of people is the desire to do it, but there's the complexity with doing it. One of the things we've done with Elevate is said, okay, let's take away so many of the pain points. Now, there are still some more effort that is required. You know, you've got to film something, but guess what? We've got these amazingly powerful phones in our pocket now that are literally the equivalent of of broadcast quality from only a few years ago. We've got so much better access to the recording equipment, but the editing environment hasn't really changed much. And that's the bit that we're really focused on.
Well, very soon, of course, you'll be able to phone from your iPhone and upload it directly into Elevate, so work on it right away, right? That's the idea.
Yeah, we're seeing more and more people who want to actually just use the phone as the device that they capture the content. And if you look at the latest phones, some of their recording capabilities are unbelievable. And so it's just logical. The only challenge with that is it's always hard to get the video out of the phone.
Yeah.
And ironically, for traditional cameras, it's very easy. You just pull out the memory card. But it's very hard for phones. And so we've made it that one step easier. and we will be releasing the mobile upload client.
How would you describe the ideal customer profile? Maybe describe it now as Elevate is today, and then in the future, and how Elevate's going to be.
I mean, we've always designed Elevate to be a general purpose tool. We plan to support a very wide part of the industry. Let's just say at least that 80% in the middle. Less bothered about the super high end and the super low end of the market. But of course, we can't talk to everyone at once. We can't address everyone at once because of the functional requirements. But we're pretty sure that as from day one, the ICP that we've always stood by is to have SMEs, the corporate communications, the people who are, for example, working in organizations where they're capturing town hall presentations and they want to send that out to their staff or to their suppliers, any of the stakeholders, or indeed that they want to produce snippets for social media. So we do see that SME market as one of our early adopters, and we also do see the content creators as well. So we're beginning to see people who are who are in the early stages, let's say, of their YouTube journey, who we're a good tool for, and we will continue to be, get better and better at that.
And as you say, there are plenty of those businesses around. I mean, tens of thousands, hundreds of thousands around the world. On the marketing side of Elevate, we've started to lean into that ICP now a little bit more. So actually the first event we did was just last week, where we met a lot of founders and entrepreneurs at a festival, and we will be leaning into that, more of that now going forward, and really seeding Elevate into that community, which is exciting. As Elevate develops further, how far do you see it going within that community? How far do you see it going up that pyramid, up that chain?
Where we are right now is we're providing a really good level of base functionality for editors. So we're able to cope with long form video. We're able to cope with some simple transitions, simple effects, and obviously stringing together a complete video that can be exported. Where we do see it going is improving the way that we manage color and grading. Mm-hmm. We see improvements in effects. We see improvements in content management coming. Now, all of these will just be unlocked, and we've got a good cadence of releasing a feature per week. And in doing that, what it means is that, like, within time, everyone who uses the product, every week it just gets a little bit better and a little bit better, a little bit better. And that will slowly unlock more people who the product would work for.
Got it. And in terms of the competitors, what are the competitors currently doing? What do you think they're going to in the future? Are you concerned about what they might be up to?
I think I'm less concerned with the online content or online editing products. Most of them are focused at the Instagram end of the market only. None of them would be a good candidate to create a 30-minute long interview sequence or documentary or even not even close to dealing with drama. For us, the competition is the incumbent way that most people make video, which is with the traditional tools. So that's when we've spoken to people, at each of the events that we've been to, or when we do it for our focus groups or our existing user base that we reach out to and we speak to and that communicate with us through our Discord channels, all of them definitely see this, the demand that we have, or the things that we need to build are usually pieces of functionality that are available in some of the incumbent tools. So we really see that as the competition.
Excellent. And so this video is really about putting a business case forward and saying to investors why they should invest in Elevate now and in Blackbird now. How would you finish this interview off by saying, what would you say to investors? Say, why now? Why this company? Why this industry?
Content creation is an absolutely booming market. Video continues to be a booming market. It spans not just the fact that it's a useful tool as a productivity tool for organizations, but it is a whole industry in its own right. Content creators, so YouTubers, for example, it wasn't even a genre in existence, but now the whole of the content creation world dwarfed television, and soon it's going to dwarf all of media. So this industry needs tools, and we provide those tools. And traditionally, these tools are the domain of Silicon Valley VC companies. They're the people who fund these, back these, get them to the right size. And for us, we're part of a UK, obviously AIM listed company. So there aren't many people like us. There aren't many organizations that sit in that domain and offer you the ability to buy into this content creation story at an early stage, because we are still, from an Elevate perspective, we are still at an early stage.
Yeah, absolutely. As the CEO, I would add to that yes, we're going through our product market fit stage now. We envisage our product market fit stage lasting into the early part of 2026. As Sumit said, the creator economy is one of those things that is usually the exclusive domain of those VCs that are sitting in the US, usually on the West Coast. It's very rare that you see a company, in fact, we think it's the only one we know in the UK, where you can publicly invest into the creator economy, especially at this very inexpensive stage. So yeah, I think that's a great way to finish. Thank you, Sumit.
Ian, Sumit, thanks very much for your time today. Before we move on, if you'd like to be automatically invited to future updates from Blackbird, then please respond to the poll now, and we'll make sure that you stay connected with the company. Now let's move on to our next company. Joining us now, we have Ben Wilkinson, CEO of Molten Ventures. Ben, thank you so much for giving us your time this afternoon. Let's just jump straight into these questions.
Molten Ventures is a venture capital investor across Europe. We invest in companies at the Series A and Series B stages. Our main capital entity is listed. Molten Ventures is listed on the stock exchange here in London. We have invested in the 9 years that we've been listed over £1 billion of capital into the venture capital ecosystem, and we've returned over £700 million in that period. The 9 years that we've been listed is building on a track record that we have of almost 20 years now as a firm investing in this market. So we have different pools of capital which we deploy into the same ecosystem of investment opportunities. The biggest pool of capital is the listed vehicle, and that's an evergreen balance sheet, which gives us the benefit of holding our winners for longer and making sure that we can accrue the value to our shareholders. We're also active managers on the companies that we invest into. We sit on the boards of those companies and give them the benefit of our broader network and of our experience. But the way that we invest is also differentiated. We can invest directly into the companies, but we can create value for our investors by investing in secondary opportunities, which means that we can buy out funds that maybe are at a later life, and means that we can buy out later stage assets, which still have growth within them on that journey. And as part of that platform, we've also invested in seed funds, which gives us access to underlying companies across the whole European ecosystem. So we would consider ourselves to be generalist technology investors. We'll have 4 broad pillars of end users, enterprise and consumer, and deep tech and hardware, and also into digital health. What we would say below those 4 broad pillars is that we're capturing subsectors of markets. So fintech would be a big prominent subsector. We'll also be focusing on AI, which sits across all of these sectors and is an enabling technology. And then we will also be investing in cloud native companies, cybersecurity entities. Digital health, as I mentioned, sits across quite a lot of these enterprise and consumer use cases. And then also in energy transition and climate change are big themes that we've been investing in. There's quite a lot of tools in the venture capital skill set in terms of managing risk. One, of course, is portfolio selection and the triaging of many thousands of opportunities that come through every year, down to just 10 to 12 new deals that we tend to do, maybe up to 15 in any given year. That vintage creation is a key part of that portfolio creation as well. We then sit on the boards of the companies in the portfolio. That gives the boards of those portfolio companies the access to our network and also our experience, but it gives us some governance and oversight in those businesses. And so by having roughly 100 companies in the portfolio now, we have a variety of vintages, but we also have a variety of different technology subsectors and different stages of maturity. And that's what our investors are buying into when they buy a share in Molten Ventures. The other factors of risk management that we see and are always enabling within our companies is looking at the capital structure of how we invest. Some of our capital is pooled, and therefore we'll have some of it coming from the PLC balance sheet, some of it will come from the EIS funds, and some of it will come from the VCT funds, always into the same deals. So it's the same quality of deals across those funds. It's just applying the filter of maturity for the applicable product. And then finally, we'll invest in preference shares. So that means that we have some downside protection in our investment structures, but not limiting the upside from when the companies perform well. So Molten Ventures has a through the cycle target of 20% annual returns. We've been outperforming this over the 9 years that we've been listed. We have seen our companies showing strength over the last couple of years in particular, and growth has started to come back in through the NAV with the growth of those underlying businesses. What we've also had to prove is the value that we hold them at in the books, and also to ensure that our shareholders see liquidity coming back through the realizations of those companies. And that's been a really strong area for us. We delivered 135 million of returns last year, all at and above the holding value. And then in this financial year, we've delivered a further 60 million coming back already. And I think those are the proof points that our public market investors need to see to ensure that they can understand and believe in the value of the portfolio. Molten Ventures has, in the 9 years that we've been listed, grown the underlying portfolio to 1.4 billion. That's come from equity raises, but also come from the strong performance that we've had. We target 20% returns in the portfolio. We call that a through the cycle target, but this is a per annum number that we're trying to deliver. And we've actually outperformed that over that period of time. The key to the underlying value of the portfolio being demonstrated is coming through realizations. Last year in FY25, we had 135 million of realizations coming through at and above our holding value. I would say that this is an area that we've been performing very well at, and it's a differentiated strength of us as a firm. And that's been further demonstrated this year with an additional 60 million of value coming through. If we look at where Molten is now with its different pools of assets, actually our AUM number is much higher than the 1.2 billion that we have on the public balance sheet, with an additional 400 million of funds that we manage alongside, principally with EIS and VCT structures. So one important thing that we've talked about is vintage creation. Quite often the companies that are the most valuable in our portfolio now are companies we invested in several years ago. A great example of that is Revolut. We invested in Revolut in 2018, and we initially put 7 million of capital to work. That value has now increased to 157 million as at the March period end. That is a great example of the upside potential of venture capital and the outsized returns that can come when the investments compound growth over long periods of time. Another example I will draw on is M-Files. We invested in that company back in 2012. We'd sat with that business as it scaled out of the European ecosystem and became really a dominant player in the US market in their area of document management and storage and the compliance that goes around those metadata files. And then eventually we sold out of M-Files last year, making ourselves a 7x return, but ultimately seeing great value delivered to all of the shareholders and the management team. We very much welcome the work that the government have been doing and other bodies around unlocking pension capital into UK innovation. We think that's crucial for pension members to get access to additional growth that they're not currently seeing in those pension pots, but also for supporting the innovation ecosystem that exists within the UK, particularly around AI and life sciences and the other technology areas that we're advanced within. For Molten, that's clearly an area of benefit where we can put more capital to work for longer durations and ensure that the growth of those businesses is supported at the right time in their journey and keeping those businesses within our European ecosystem. I think what we're seeing right now is a generational shift in technology. Clearly, the technology waves of the past, be they PCs or moving into SaaS, cloud computing, have driven new waves of innovation, and we're seeing that now. What is definitely true though is that those waves of innovation are shortening and also overlaying, so we're seeing quantum coming on top of AI. And I think that's a great opportunity for venture capital investors, particularly within Europe where we have strong technology ecosystems, to benefit from the growth and the disruption that's coming. I think the first benefit of Molten Ventures is the depth that we have within our market. in terms of the track record that we've generated, but also the nearly 20 years that we've been investing in this ecosystem. The brand is very strong, and that drives good proprietary deal flow to our teams of experts. In addition to that, an investor into Molten Ventures buys into 100 companies in day one. They're getting access to the growth of those underlying businesses, and it's supported by the governance structures of a listed entity, but also the breadth into the private markets that allows us to invest in different structures, be that direct investing or also creating value through secondaries and the benefits we see with the fund of funds. At Molten Ventures, we make more possible by backing innovation in Europe to create value for the future. Thank you for your attention and for joining us today.
Ben, thanks very much for your time today. Before we move on, if you'd like to be automatically invited to future updates from Molten Ventures, then please respond to the poll now and we'll make sure that you stay connected with the company. Right, moving on to our next company. Joining us is Emma Salthouse, CFO from Active Ops. Emma, thanks for being with us today. Let's get straight into things. Can you tell us a little bit about Active Ops and why investors should be paying close attention right now?
Perfect, thank you very much. So I am Emma Salthouse, the Group CFO of Active Ops. In today's session, I'm going to initially talk you through a quick overview of who we are and what we do, a very quick look into our commercial model. I'm then going to touch on a recent acquisition we made of Enlighten, and then finally, just a quick look at our strategy for the short to medium term. Okay, so what is Active Ops and what is it that we do? We are a leading provider of decision intelligence software for large enterprise organisations. What does that mean? We provide a software which enables leaders to connect work and capacity. In doing so and having a common language across large organisations, typically we will see customers increase their productivity by 15%. When you extrapolate that across a large organisation, such as in the financial services, customers typically will see an improvement in the achievement of SLAs, being able to do more with less, reduction in headcount and a reduction in overtime. Why is there a need for something like Active Ops? The world of operations has never been more complex and continues to get more and more complex. Typically, the world of operations is an unregulated and structured profession. Therefore, each organisation and team is very reliant on individuals knowing best practice and ensuring that they are all communicating together to share and offload resources to each other. Our solution does that for them on a large enterprise scale. We have 3 products in our product suite. We've got Control IQ, which is an AI analytics tool, which identifies utilisation and capacity. We then have Casework IQ, which works in a similar fashion. And then finally, we've got Work IQ, which is a desktop analytics tool. Whilst we are a UK homegrown tech business, we operate on an international platform. In the UK, our revenues are just over 55%. We've got 25% of our revenues coming from North America, which is split between the US and Canada. And then finally, 19% of revenues coming from Australia. In terms of top line revenue, we have a split between SaaS revenues and training and implementation. So 88% of our revenues comes from ARR, with the remaining 12% coming from training and implementation services. To put all of this into a customer case study, here we have an example of Fidelity International. Fidelity International initially rolled out Control IQ in 2023 with 246 licenses. Fidelity were going through a transformation period, and as part of this journey, they wanted 2 things. Firstly, they wanted to be able to increase their operational resilience. They wanted to be able to continue to grow and scale without growing their bottom line cost base. And then finally, they wanted to ensure that all of their decision making was data driven. The solution for that for them was Control IQ. We implemented Control IQ and very quickly we went through an expansion. Today we have over 1,000 licenses with Fidelity International. One of the key outcomes that they have seen from using our solution is an increase in productivity of 21%, which equates to a delivered extra work capacity, which is the equivalent of 125 people. So they're able to do a lot more with less. They're able to continue to scale without having to increase the bottom line cost base. In terms of the key strengths of Active Ops, so firstly, we are in a growing market. As I mentioned before, the work of operations has never been more complex and continues to get more and more complex. The current TAM within the sector of the top 250 customers that we currently track is 800 million in ARR. But actually what's also impressive is within just the existing customer base alone, we have an additional ARR potential of 130 million. We have a number of blue chip customers. You'll see a couple of the brands along the bottom, which I'm sure you will all recognise. We've got a very robust business model. So we're highly cash generative, we deliver high margins consistently, and we've got high growth as well. And at the moment we are investing in accelerating that growth. We are currently investing in our sales capacity and sales leadership and management. In terms of a quick overview of the commercial model of ActiveOps. So firstly, as I've mentioned, the majority of our revenue comes from ARR. These are the results from the recent year-end FY25, where we saw an increase in constant currency basis for SaaS of 14%, total revenue growth on a constant currency basis of 15%. We've got ARR levels of 28.4 million at the end of FY25, which gives me great visibility on the revenues to come. Typically, as we enter a financial year, we will know roughly around where 90% of the revenue is coming from that year ahead. From a cash position perspective at the end of FY25, we had just under £21 million of cash, which was an absolute increase of 3 million year on year. In terms of from a profitability perspective, you'll see that at the end of FY25, the EBITDA was 2.5 million, and the previous year that was 2.4. One of the things we have done in FY25 was incrementally invest in our sales capacity. We started the year with 8 quota carriers and we finished the year with 14, which is one of the reasons why the EBITDA year on year we have seen a small increase but broadly has remained in line year on year. However, we have set the business up for future success. In the years ahead, you'll start to see that operational leverage come through to the bottom line EBITDA. In terms of a robust P&L performance, so some of the key metrics is the gross margin. We deliver consistently a strong margin of 84%. We've got total revenues of 30.5 million, which is an increase year on year of 15% on a constant currency basis. From a PBT perspective, last year was our maiden year for PBT, which we have consistently delivered for FY25 as well. We do capitalise labour, so we capitalised £1 million of R&D spend in FY25, which was a small reduction on the year before of 1.3 million. So what we have here is an example of what we mean by land and expand. Here we have an example of one of our Tier 1 UK banking customers. What is very typical within ActiveOps is often when we first land a new logo, we will go into a particular geography or department. Very quickly, what you will then see is a scale of users across into other departments and then into other geographical locations based on the successes they are seeing. That is very much what happened with this customer, and most of our customers will follow this same pattern. Initially, when we onboarded this customer in FY17, they had ARR of 300k. By the end of FY19, they had ARR levels of just over 1.5 million, increasing the ARR fivefold in that 3-year period. What we then did for the next few years is we maintained this customer. And during this time, we re-platformed our solution from the legacy branding of Workware to Control IQ. The re-platforming of Control IQ allowed us to do a few things. So firstly, we were able to launch Casework IQ, which is ultimately a sister product which works in a very similar way to Control IQ, however, is more tailored to casework type teams. So it increased our user footprint and potential within the TAM and the addressable market within existing and new. And then secondly, it actually allowed us to bundle future releases. In our legacy product, Workware, we had an all-you-could-eat subscription. So if we were to release a new feature, it would be included within the price. What we have today is the ability to bundle new features together and charge a premium for those future releases. We released Series 3 2 years ago, and what we have seen on average across the last 2 years is any customers that have moved from the legacy functional equivalent version of 2.5 up to Series 3, we have seen an average increase in ARR of 24%. We actually have just recently also released Series 4. We're too early in the product lifecycle at the moment to release any statistics in terms of what's that incremental ARR uplift potential is to go to Series 4, but it should just give you a scale of the opportunity that we have ahead of us today. There is an upsell opportunity within our existing customers of 50 accounts in which are yet to move from Series 2.5 up to Series 3 and then up to Series 4. And then within Casework IQ, we've got a seat expansion opportunity within 45 existing customers where Casework IQ would be a relevant product for them, and we are currently talking to them around the cross-sell opportunity that we have there. One of the big news stories for us in FY25 was the new logo wins. During the year, we secured 9 new logos, which is the highest we've done for a number of years. What we've done here is to show you the potential impact of those new logo wins from last year. So the new wins from last year added an incremental ARR of 1.8 million. However, the opportunity within those 9 customers to increase that tenfold, and the actual ARR potential in those 9 logos is 18 million. And as you can see here, around that level of penetration, we've got a huge expansion opportunity ahead of us. Finally, just to close out on the commercial model, we've got a very healthy balance sheet as an organisation. We've got high levels of recurring revenue, so around 90% of revenues is coming from SaaS ARR, which gives us great visibility into the year ahead. We're highly cash generative. We've got a very strong cash balance position on the balance sheet. We've got multiple expansion opportunities with the cross-sell and upsell, and we're sustainably profitable from this point onwards. Okay, so recently you may have heard that we completed on the acquisition of Enlighten. And Enlighten was essentially the closest that we had as a competitor. So we acquired the business at the end of June this year. What we have done is essentially base the cost of the acquisition on a multiple of ARR. So this organisation has added an extra 8.5 million of ARR to the ActiveOps group. The total amount of consideration we are looking to pay is 16 million, so 2 times. The initial consideration was 6.3, and the remaining consideration is going to be based on an earn-out over 2 years based on the retention of existing contracts. So what are the benefits of the Enlighten acquisition? So firstly, it strengthens our market positioning. As I mentioned, they were the closest we had to a competitor. It also brings in some new capabilities which we'll be looking to replicate on our current Control IQ and Casework IQ platforms. It increases the TAM, so we now have the opportunity to cross-sell Work IQ in particular into their US customer base. And it will be earnings enhancing. The organisation of Enlighten was operated as 2 separate businesses across the US and Australia. So within the integration of just combining that entity to operate as one sole entity, there is a huge amount of cost synergies. But when you roll that into our own infrastructure and our back office functions, there is an incremental level of synergies and earnings enhancement, which we'll be going through. We have laboured with the market that FY26 for us is the transformation year, and you'll start to see earnings benefit from FY27 and beyond. It does accelerate our product roadmap. There was some functionality and some features that we as an organisation were already looking to include on our product roadmap. So it accelerates that opportunity for us. As an organisation, we are well positioned to address the significant market potential that we have. We typically operate in 3 target sectors, being banks, BPOs and insurance. Currently, our existing ARR with the addition of Enlighten sits at 36 million. If we were to look at the growth potential just within the existing customers that we now have, there is potential to increase the ARR by another 130 million. If you then overlay that with the TAM of the target 250 accounts, that's an extra 900 million of ARR. So we are not constrained by TAM in this organisation, which is one of the reasons why we decide now is the right time to invest in our sales capacity. We typically target the 250 accounts within Anglo-speaking countries. So again, if you to actually look at the potential within the entire sector, the total addressable market is significant. However, at the moment, we are targeting the 3 traditional ones for us, so banks, BPOs, insurance sectors. However, into the future, there's the opportunity to broaden those sectors and then also deepen the sectors as well. The main focus areas for FY26 is firstly to continue the investment in the go-to-market capabilities. We've significantly invested in our sales capacity during FY25, and we are continuing to monitor and seeing the results of that investment into FY26. We've also increased the management bandwidth by onboarding 2 significant hires in senior positions to help us focus on the organic growth opportunity that we have ahead of us. We will continue to evolve our offering. So firstly, we are looking at the WorkIQ Cloud and also the WorkIQ Convergence. At the moment, WorkIQ has its own separate platform and infrastructure. We are looking to merge and to build WorkIQ into our ControlIQ platform, making it easier to cross-sell WorkIQ within our existing customer base today. I mentioned that we rolled out Series 3 2 years ago and that we rolled out Series 4 earlier on this year. The product team and tech team are already working on the release of Series 5, which we would expect to launch in FY27. And then finally, following the recent acquisition, one of the key focuses for us in the next 12 months is the successful integration of Enlighten. Thank you very much for your time.
Before we close today's session, if you would like to be automatically invited to future updates from ActiveOps, then please respond to the poll now and we'll ensure that you stay connected with the company. So that concludes today's Spotlight event. Our huge thanks goes to our presenters for sharing their investment case and to all of you joining us today. We'd like to hear from you and we'll shortly redirect you for your feedback. Your feedback is really important to us and it really does help shape the conversations between companies and investors moving forward. So thanks once again for your time this afternoon. We look forward to seeing you at our next Spotlight event.